Ladies and gentlemen, welcome aboard the Pilot Money Guys podcast, where our mission is to help clients build and protect wealth to achieve their dreams and goals. This podcast is brought to you by Leading Edge Financial Planning. Without further ado, here is your host, Robert Eklund.
Well, a tip of the cap to you, and thank you for joining us here on the Pilot Money Guys podcast, where we talk about some aviation news and aim to bring you some lighthearted financial fun. I'm your host, wealth manager, and airline captain, Robert Eklund. Call sign Rubber Mallet. That's what we do here on the Pilot Money Guys. Give people call signs, terrible call signs, because I'm a tanker guy. Don't know how to do it. I'm, of course, joined on this flight by certified financial planner and former airline pilot, Charlie Mattingly, call sign The Godfather. Welcome, Godfather.
All right. Thanks, Rob. Appreciate it, man. Thanks.
Excited to be joined by the professor, of course, Kevin Gormley, who is a certified financial planner, personal financial specialist, certified public accountant, and all-around good guy. Welcome, Professor.
Thanks, Rob. It's great to be here. Great to see you guys.
Yes, and today we are diving into an interesting topic and very interesting asset class called real estate investment trusts, or REITs for short. You've probably heard of them. Accordingly, our special guest today is John Worth, the Executive Vice President of Research and Investment Outreach at REIT. He holds a PhD in economics. Do you say economics or economics, John? I want to get this right.
I'm an economics guy.
Economics. PhD in economics from the University of Southern California. Prior to joining REIT, he was the chief economist of the National Credit Union Administration and also spent nearly a decade at the U.S. Treasury, where he served as the director of the Office of Microeconomic Analysis. He's also worked at the Rand Corporation and Welch Consulting. Welcome to the show, John.
Thanks for having me, Rubber Mallet, Godfather, Professor. I'm gonna give myself the call sign Dr. REIT.
Oh, I love it
for today.
Yeah,
nice work.
I
love it.
Yeah,
I know you don't get to make up your own call sign, but you know.
That's
we
good
didn't
one.
know you were that
like
smart. You're a PhD. You're smart. I like Dr. REIT. Let's do it.
Dr. REIT has a nice ring to it.
Yeah.
Well, other than your school and work history, tell us a little bit about yourself, Dr. REIT.
Well, one thing, just thanks for having me on, guys. I fly a lot. I actually play tennis with a bunch of pilots. So I am, very much enamored with your profession. It's amazing that you guys get people from place to place with an amazing safety record. I tell my wife all the time, the most dangerous thing I do when I go on a business trip is drive to the airport. Mm-hmm. Once I get to the airport, I'm safe. So appreciate what you and your listeners do. It's a great profession and one that really serves us all incredibly well. For me, obviously I work at REIT. We do a lot of research and investor outreach around REITs and real estate, how it works in a portfolio. For fun, I play tennis, work out, all the normal middle-aged guy stuff.
No, wait, Dr. REIT, no pickleball. Now, what's going on here? Have you transitioned over? What's going on?
I'm sticking with tennis until I have to transition. My knees are still in good shape, so as long as I can play tennis, I love that people are out playing pickleball. I love having them out there sharing the courts. We got tons of tennis courts in America. Get out there and use them. But for me, I'm going to stay on the tennis side until I have to.
Awesome.
I love it. So for those of our listeners who haven't heard of REIT, why don't you tell us a little bit about their mission, priorities, what you're working on? Yeah,
so REIT is essentially we call ourselves the representative voice for REITs in the United States. And we're really the trade association for real estate investment trusts. Real estate investment trusts are companies that own and operate commercial real estate. And what's unique about REITs is that they're available for individuals to purchase and own a stake in. So you could do that through individual stocks, you could do that through mutual funds, through ETFs, all the ways that you're sort of investing today. REITs are available through those channels. And so what we do at REIT is, we represent REITs in Washington. That's where I'm based. We have a team who makes sure that as legislation is being considered, that essentially that REITs aren't forgotten. We don't have any natural enemies, as we like to say here in DC, but occasionally, folks will sort of in the heat of legislative moment forget about REITs. We're here to make sure nothing goes wrong, to keep the system safe and stable. what my team does is we get a set of researchers and a set of folks who work on investor outreach, and we do research around the role of real estate fundamentals, and how REITs deliver those, and then a team who goes out and talks to pensions, defined contribution plans, financial advisors, and individual investors, again, about what the research says about how REITs can perform in a portfolio, and why individuals might want to have those real estate returns in their portfolio.
Yeah. So, John, you just kind of teed up the next question. Is why? How large is the REIT market, and why should investors care about REITs? Recently, stocks have been exciting to be in, especially growth stocks. So, if you can talk a little bit about that.
Absolutely, yeah. The listed REIT space today is about $1.3 trillion in market cap. And so that's just 2.5 or 3% of the stock market overall. What I think is important to keep in mind is that when you ask the question, how important is commercial real estate in the economy, you get a very different answer, right? So today we estimate that if you think about the investable market basket, so stocks, bonds, cash, and commercial real estate, how much of that is commercial real estate? Well, it's really somewhere between 15 and 20%. The last time we did the analysis, it was about 16% of that total. And so if you think about being fully diversified and having a portfolio that really reflects the broader investable universe, you want to have real estate in that portfolio. And I would argue that you really need to get more real estate in your portfolio than you're likely to have if you're just getting it as part of a diversified stock portfolio. So if you go buy an S&P 500 ETF, let's say, you're going to get 2.5% of that is going to be in REITs, commercial real estate. But if you compare that 2.5%, and maybe you're in a 60-40 portfolio, right? So it's you're talking about 1.5 to 2% of your assets representing commercial real estate. Compare that to the 15 to 20% of the investable universe, and you're really deeply underweight in commercial real estate. And so you're missing out on the benefits commercial real estate provides. We can talk about those, but diversification, I think, is really critically important that real estate provides, as well as being an income driver and often having some inflation protection built in.
I love it. Yeah, you went there, so I've got to go there too. But the U.S. REITs, making up around 3% of that market cap, that argument could be made that that's the bogey for a market weight portfolio, at least the starting place, and to your point, maybe even higher. And advisors know their client's situation, so that's why what we've talked about, at least Charlie and I've talked about. I don't know if Kevin and I have talked about it, but REITs, when you talk about that real estate investment, knowing what your client's net worth is, their primary residence, their secondary residence, other real estate that they hold, that's how you kind of come to that conclusion. But anyways, I had to jump in there.
No, I think that's a great point. And we did a survey of financial advisors in the last couple of years. And one of the questions we asked them was, are you recommending REITs to your clients? And, more than 80% were actually recommending REITs to their clients today. And then we went and asked them, how much REITs are you using? And what we saw was by age of the client, we saw that the recommendations were really anywhere between 8%, between 4% and 12%. So a pretty healthy allotment to REITs. And that interestingly maps really closely to research we've done with Morningstar, Ibbotson, Wilshire Associates, a number of research firms that has all come down showing across the life cycle, you want somewhere between, we say 5 and 15%. Sometimes the number comes in a little higher, sometimes it comes in a little lower at the top end, but anywhere in that range across your life cycle. And that's what we're seeing target date funds starting to do. We're seeing more and more target date funds incorporate REITs, not up at the 15% level, but we're seeing some 8 and 9 and 10% in target date funds.
John, Rob just mentioned about like people owning real estate. And so as financial planners, sometimes we're not sure if somebody owns, 3 rental houses, if REITs should still take what's your view on that issue of owning real estate in other ways versus REITs, which are commercial real estate?
Well, I think I would make a real distinction between if they're owning investment real estate, in which case I think, their REITs and other types of investment real estate, they can definitely be substitutes. Now, REITs are going to give you a much more diverse portfolio, right? If you own 3 rental houses, you've got the idiosyncratic risk of 3 tenants, most importantly, 3 neighborhoods. With REITs, you buy a REIT index, you can have access to over 500,000 structures around the country, right? So you're getting across property types, in a very diverse set of property types that we can talk about. Where I do think sometimes it's a little bit of people get a little bit offline is saying, well, I own this big $1 million house, so I've got my real estate allocation. And there, what we see is that residential, your single family house that you live in, that has a very, very different performance track record than commercial real estate. So what we see is that, historically, single family homes, my residence is a great example of this, have a very low rate of return, right? And a lot of idiosyncratic risk. And if you actually tabulate how much money you put into that house, they're almost all money pits. Now, you could get lucky on where you live and when you bought, but for most people, you're talking about low single-digit rates of return, whereas commercial real estate is much higher, has historically much higher rates of return, and the correlation between single-family housing and REITs generally is not actually that high. So what we really recommend is just because you have a house, that doesn't mean you don't need commercial real estate in your portfolio. I like to think of the house really as consumption with a little bit of a forced savings kicker, right? That I'll probably never enjoy. It'll probably be my kids will get that someday, and they can do whatever they want with it. Whereas the investment portfolio, that's really return driven, and that's going to be all for me.
This perception of real estate, specifically REITs, post-COVID, in that, man, well, nobody's using commercial real estate anymore. Nobody's going to the office anymore. And what we've learned in preparing for our discussion with you is, and from what you've already discussed with us, is that, boy, it's very different now. What's the guts of a REIT, a typical REIT fund, ETF or whatever, are very different than what people anticipate maybe.
Yeah, I think that's exactly right. And I'll tell you, throughout COVID, sort of the COVID period, I'd go out and you'd run across people, you'd chat with them a little bit. What do you do? I'd say, oh, I work in commercial real estate, REITs. And these people say, oh man, sorry to hear that. Let me buy you a drink or something. I said, no, everything's fine. Everything's fine. We're okay.
Did you take the drink?
I always take a free drink.
Okay.
But yeah, but then I tell them, no, actually, we're fine. Because I do think that for individual investors, you could get the perception that commercial real estate is maybe really struggling. And the example I use is there's a lot of folks who they were working 5 days a week in the office. Now maybe they're going in 2 or 3 days. They haven't set foot in a mall that is in the time that they can remember, and they start thinking, "Oh boy, is commercial real estate struggling?" Well, commercial real estate has really changed dramatically, and a lot of it in ways that you can't necessarily see, because commercial real estate is really housing the economy. The economy has changed. So if you look at REITs, we've got nearly 10% of our market capitalization in data centers. So not a traditional form of real estate, but one that has become incredibly important and one that investors are getting access to through REITs. So that was the best performing property sector last year, driven by the AI boom. We've got telecommunications towers, so cell phone towers. Again, that's more than 12% of the index. So supporting sort of mobile devices and cell plans. Industrial is over 13% of the market capitalization. So that is, logistics facilities that are really housing e-commerce. Apartments, nearly 10% of the index. So, we've got traditional retail at 14%. Malls are actually, if you actually go to them, they've recovered. They're doing quite well. Strip centers are doing great as people are working from home. And property sectors like office, which is still 5% of the index, but a much smaller share of the index than people imagine. Office is going to go through challenges over the next couple of years as we get ourselves around what it means to work from home, how that works for different workplaces. Our general sense is that this is going to be a challenging environment, but we think that there's going to be a quality divide in office. REITs tend to own the high quality office, which are going to be the winners in that. But the overall exposure for the average investor who's buying either a mutual fund or an index fund is not going to be tremendously large, whereas they are going to get this great exposure to these new and emerging property types that are going to grow with the modern economy.
Yeah.
And I guess you guys don't get to work from home, so as pilots, but thankfully.
That would be tough.
Yeah. Well, I love that, John, and it's way, the only free lunch is lots of people have said in investing is diversification. And this is a way, you're not going to go out and likely buy a commercial office building. And if you are, it's not going to be the winners, as you say. So I just love it because you're getting into a space where you're not just investing in one country even, or one state or one town or one subdivision. You are broadly diversified through that real estate. And, we look a lot at the Callan chart, the periodic table of investing, those charts that we've talked about on this podcast before. And real estate, even in 2021, post-COVID, was the second asset class, highest returning asset class, which is interesting. Now, down year in 2022, but going forward, what are your thoughts on it?
Yeah, so just to set the stage, 2020 REITs had negative returns. They were down about 5%. Tough year. Huge rebound in 2021, up more than 40%. Tough year in 2022. Recovered strongly at the end of 2023. Ended the year up about 11%. In our year-end outlook, and we don't make a lot of forecasts of sort of returns. But in our year-end outlook, one of the things we looked at was what happens to REIT returns versus the broader stock market versus private real estate at the end of monetary policy rate rising cycles historically. And what you find is that when you get to the end of that Fed rate rising cycle, REITs over the next 6 months or 12 months definitely historically have outperformed both the broader stock market and private real estate. So we feel actually quite bullish on REITs for this year because of that historical track record. Obviously, past is not always prologue, and your results may vary, but and all those caveats. But we think they're well positioned. The other thing about REITs that gives us a lot of comfort and enthusiasm for this year is that REITs have come into this higher interest rate environment with very well managed balance sheets. So they had been reducing their leverage, reducing the amount of debt on their balance sheet, really since the financial crisis, and at the same time terming out the debt that they have. So that they've got a weighted average term to maturity of about 6.5 years. And so what that means is that they've got a lot of room to navigate this higher interest rate environment. And that's in a world where you've got a lot of other real estate investors, commercial real estate investors, who are using quite a bit of debt and are going to have to refinance that debt in the next coming years. And that puts REITs, I think, one, in a very safe position, but two, it puts them in a position where they can start to be opportunistic. As other investors are not able to step into deals, as other investors need to get rid of properties because they've got debt coming due, REITs can be one of the buyers who step into that and find deals that can help them be more profitable over the next 5-10 years. So we have a lot of enthusiasm for 2024 based on how 2023 ended, and I think I'm more and more confident that the Fed is done raising rates, and I think the consensus seems to be back half of the year we'll see some declines. I think for commercial real estate and for REITs especially, as long as we have stability, they can perform well through that period.
Yeah, so Dr. REIT, I'd like to talk about how REITs have behaved in the past as an asset class. Now REITs are technically an equity position. They have unique taxes, which I'd like to get into later, a unique profile, unique returns with 90% of the income after depreciation, et cetera, being passed along. But as far as how that asset class behaves versus stocks, how does it behave versus stocks? How does it behave versus bonds? I mean, how do we think about you said putting some REITs in a portfolio. How do we think about what kind of diversification it might bring?
Yeah, REITs are a terrific diversifier, and to quote Rubber Mallet, diversification is the only free lunch. I say that all the time, and it's amazingly true. So REITs, correlation of REITs with the broader stock market over time has then really been in that 0.6 range. Sometimes we'll see, depending on where you measure it, you might see it up around 0.7. But if you compare that to, so that's on a scale of, positive 100 to negative 100, REITs have a 0.7 correlation. I think it's important to put that in perspective, because if you think about large cap, small cap, tech, growth, even international stocks, those are all going to have correlations of 0.9 and up. So it's very difficult, and you guys as advisors, it's very difficult to find uncorrelated assets in this world. Mm-hmm. So REITs are really a relatively uncorrelated asset, and that's why they find themselves in these optimal portfolios, right? Because they've got stock-like volatility, typically slightly above stock-like returns, depending on what time period you measured over. But you get that low correlation that really helps in creating a portfolio that's more stable and has a lower all-in volatility. The correlation with bonds also quite low. So that's really I think for individual investors, if you want to talk about two things that are going to drive them to REITs, one is, I think especially during that accumulation phase, is that low correlation that gives their portfolio more stability with the same returns or slightly higher returns. And then once you're in that retirement phase or starting to head into that retirement phase, you get the income that REITs provide. REITs right now have a yield that's about 2.5 times the S&P 500 yield. It's running around 4%. And historically, REITs have been about provided a yield that's at least twice the broad stock market. And Kevin, that goes back to the taxation of REITs, which is why they're paying out typically about half their total returns. If you think about REITs returning last year, 11%, half of that return would have been price return, and about half of that return would have been in income, so paid out in the form of dividends to shareholders, which is why for retirees who are looking for an income-driven portfolio, we see pretty heavy use of REITs by financial advisors.
Mm-hmm. Yeah, and as a follow-up, so a lot of our pilots they do invest on their own. We'd love for them to call us as well. But like, where should an investor put REITs? Used to be said that it couldn't go in a taxable account. Now, with some of the tax changes in the last regime, there is a qualified business income tax deduction. Please don't look it up; it's boring. You don't want to know anything about it. But John probably knows. But anyway, where should investors put REIT funds?
Yeah, the conventional and so the way REITs are structured from a tax perspective is that REITs as corporate entities, if they pay out at least 90% of their taxable income in the form of dividend to their shareholders, now most of them, or the vast majority, are going to pay 100% or more of their taxable income out, then they get to deduct that dividend from their corporate taxes. So in practice, what that means is that they're not paying taxes at the corporate level. Those taxes do get paid, though. Those taxes get paid by the shareholders on that dividend. So they're paying the regular dividend rate, essentially their marginal tax rate on that dividend that's paid out from the REIT. So the conventional wisdom has always been, if you can put that, if you have the flexibility, you put the REITs in your IRA or tax deferred account. And you do your other investments outside of that, and I think that conventional wisdom is right. The only thing I would add to that is, I wouldn't not have REITs in a portfolio if you can't fit them into the IRA for whatever reason, because while you are paying, you're gonna pay taxes on it. Those taxes were reduced effectively by 20% in the Tax Cuts Act of 2017, and so the tax burden has been reduced. And even after taxes, I think that diversification and growth benefit is worth having in the portfolio. But yeah, the conventional wisdom has been put those in the IRA. I think that's the right approach if you've got the flexibility.
Excellent. Thanks, John. And you were talking earlier about the correlation of the assets and things like that, and how we essentially design portfolios. And I just wanted to kind of, for our listeners, the correlation or lack of correlation is a good thing, because it means investments behave differently, and that's what we're trying to look for when building a portfolio. And we need those different assets in a portfolio that zig when one's zag, or whatever pithy statement you want to use there. But that's why that correlation is so important that you were talking to. I just kind of wanted to elaborate on that a little bit for our listeners that may not know the word correlation so well. So that's a big deal, is what you're saying anyway.
Absolutely right. You want a portfolio, as you say, that when one zigs, the other zags, and so that means when your stock portfolio is down, maybe your REITs aren't down as much, or maybe they're up, and that creates overall stability in your portfolio. Just like if you're putting together a podcast of pilots, right? You wouldn't want 3 fighter pilots. You want 1 fighter pilot, 1 tanker, 1 commercial. Yes. You gotta have a diverse portfolio.
That's right. That's an even better analogy. I like it.
One young guy, one old guy.
Yeah.
I'm glad. Wow. I'm glad you didn't say 0 fighter pilots. That's good.
I think the tanker guys say something about what happens to the fighter pilots without the tankers, right? But
yeah, exactly.
Yeah.
Hey, Dr. Reed, how do you know someone is a fighter pilot?
How?
Because they'll tell you every time. Sorry, Charlie.
That's all right. It's true. It's true.
That's a good one, actually.
Yeah. Dr. Reed, you talked about the dividends, and that's one of the characteristics of REITs that I love is you're getting this, they're collecting rent. And, Charlie and I have talked about this. We don't have to be the ones collecting rent or managing a property, or, the liquidity of a REIT. It trades, like a stock, obviously, the ETF. So very easy to trade and sell and buy, unlike, traditional property. If I'm buying a house, obviously I have to wait for the real estate agent and go through all that hassle. And this way makes it really easy to do that kind of stuff. I just wanted to point that out.
Absolutely. And I think, if you think about it relative to, trying to own and operate property yourself, basically what you've done is you've said, I'm not going to be a do-it-myselfer and own 1 property or 2 properties. I'm going to hire world-class management teams, teams of hundreds and thousands of professionals who are going to not only get me, the return from 1 or 2 apartments, but they're going to get me returns from property classes that I might not even know exist, much less know how to operate. So, if you think about running a data center or a network of cell phone towers or self-storage facilities or, hundreds of apartment complexes, these are complex businesses that require, prop tech. There's a lot of technology that's gotten built into running these properties. Data science, advanced management teams and finance teams. These are really being run as state-of-the-art facilities, far beyond what, frankly, most individuals could expect to do, and with far more diversification across both the properties and the property types.
So, John, a lot of clients will, talk about residential real estate, and everybody knows what's happened in residential real estate the last few years. It's gone up. If you weren't paying attention, gone up a lot. And so, when I've had conversations about REITs with clients, they've said, can I buy residential real estate in REITs? And I know the word is commercial real estate that you used. So this might be one of those oxymoron times, but Jeffrey Gunlock, Value Lines, Jeffrey Gunlock last week was quoting some material about multifamily housing coming onto the market in 2024. I heard about 600 and something thousand new residences are coming on the market. Is that something that commercial real estate has gotten involved with, or what's the situation with multifamily housing and even single family housing?
Yeah, multifamily is really part of the REIT world. We've got apartment owners, both sort of downtown urban apartments, sort of garden apartments in suburbs, as well as single family rentals. They're being really run as portfolios of thousands of single family rental units, and those are, we call those, jointly, we put those together in the residential sector of REITs, and that's, today that's about 14% of market capitalization. And so there's access to those property types, through REITs, and it's a critical and since the beginning has been a key part of the REIT investment thesis. And one of the great things about multifamily and in particular is sort of apartments is that today, in the U.S. we're somewhere between 5 and 7 million housing units short of where we should be given population growth and demographics. And so even though there's been a tremendous amount of construction in the multifamily sector, and that construction that may dampen rents, for the early part of 2024 or even through 2024, but the long-term demand drivers are really strong. And that's, a lot of long-term investors, what they're interested in knowing is, what are those longer term demand drivers? Are demographics playing in my favor? Is technology playing in my favor? And I would say multifamily is definitely an area where, you might have near term softness, but over the long term, we need a lot of housing. It takes a long time to bring it online. And so in the near term, that helps really support returns.
So 60 Minutes did a show about a week ago on office REITs, and I don't know if you saw it, John, but they were showing some Manhattan buildings and how empty they were, and some people coming in. So one of the other questions that I've been asked a number of times is like, why don't we take all these offices and make them into something else? What's the ability to turn offices into other types of properties? I mean, Soho in New York, that was something they did with old warehouses.
Yeah, I think the ability to do conversions really depends, on the property and the property type. If you think about New York, I think, sort of downtown where you've got smaller buildings, older buildings, smaller floor plates, there's more ability to do conversions there than say in Midtown where you've got, sort of big skyscrapers with very large floor plates. Those become difficult and very, 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 very expensive to do conversions to residential. The other thing that will happen over time is as as if rents decline, and it's important to keep in mind that just because an office isn't occupied on a given day, that doesn't mean rent is not being paid, right? So all these businesses who are having their folks come in 3 days a week, if they want to have all their team come in on the same day, which is becoming the norm, to really say, okay, we're gonna work, we're gonna have a hybrid work schedule. Most people are going to choose to come in Tuesday, Wednesday, Thursday. That's sort of become the norm. But we want to get the whole team together on those days so we get the benefits of collaboration and working together. Well, if that's what you're doing, then the degree to which you need that space really only declines by a small amount. So that's not to say that demand is going to go up or is not going to decline, but it doesn't decline in a straight line given the share of time you're in the office. So one of the things we saw at the end of last year was that we saw a real bounce back in office REITs. So from the middle of October through the end of the year, office REITs were up more than 30%. So that reflected the lower interest rate, hope of a lower interest rate environment. But we thought it also reflected the degree to which we're seeing people not just paint all office with the same brush and really start to differentiate between higher quality office, which is doing quite well actually, and sort of low and mid-tier office where the challenges are. The other thing I'll note is, if you spend some time in New York, I went to see a play recently in an office that was in a building that was clearly a converted office, right? So it's not just housing. You might find art studios and plays and all sorts of things will take that space as rents come down.
I just have two more guys, but do you have anything before I keep chiming on?
I'm good. Yeah, I'm good, Kevin. Keep on.
Go for it.
Okay, so I noticed on the website that you work with worldwide REITs. Is that the case? That
Absolutely. We've got REITs there are REITs today in over 40 countries and regions globally.
So one of the comments from an asset manager who I won't mention, especially if this is wrong, is that the governance around the world is not as good as it is in the United States for REITs. Can you just discuss what your thoughts are around governance and making sure they're paying out the rents and that kind of stuff?
Yeah, I think one of the things that I always make the case that in terms of corporate governance, REITs are actually don't actually get enough credit because one of the keys to corporate governance, right, is letting your shareholders get their money back. And REITs have to do that because they don't have retained earnings. They're paying the dividend out to the shareholder who can decide whether to reinvest that dividend or not. So that is, of course, the ultimate shareholder control, is getting your earnings back and the ability to sell the shares. Now, I think as you go around the world, in the U.S., we generally across stock market sectors, we have a very high level of corporate governance. In REITs, I think we have an exceptionally high level because we have all the standards of corporate governance, plus the ability to, or the requirement to pay out the dividend, I think provides shareholders with an incredible amount of control. And we've seen that corporate governance, I think, really pay off for REITs over the long term in terms of their returns. As you go around the world, I think I don't think this is unique to REITs. I think it's really when you invest globally, you know that one of the costs of investing globally is that you're going to be investing in different regions that have different levels of disclosure, different levels of corporate governance, and different levels of shareholder control. And that's why I think as you think about investing globally, that's one of the places where I always recommend, that's where there's actively managed funds as well as passive funds, but those actively managed funds, they're really exploring those regions in depth, and they've got teams on the ground, and they understand not only the companies but the regions really quite well. And so that provides, I think, a real advantage for an individual investor, is to rely on their expertise.
No, that's awesome to hear, and thank you for going through the governance. I didn't realize REITs were, there was different rules with the income that needs to be paid out. So that's great. My final question is just uniqueness. What is the most unique REIT that you've come across? We don't recommend individual stocks, just to mention that, or individual REITs, I should say. But is there any REIT that you're like, wow, I can't believe a REIT got into this?
Yeah, that's a great question. We've got REITs, that specialize in areas from post offices to FBI and defense facilities, through to casino properties. And I mentioned the data centers, the cell phone towers, self-storage facilities, healthcare facilities. The range it's pretty much, if you can imagine it, there's been a REIT dedicated to it. And I always like to give the example of the gaming REITs, which they sort of own properties that house casino hotels. So today, REITs own about half of the Las Vegas Strip, for example. And I think this is a great example because 5 years ago, this sector really didn't exist. And but somebody saw a need. They saw that the casino operators, they needed a lot of capital because they all wanted to launch online gaming platforms. They wanted to invest a lot of capital in that. And so they said, we will be that source of capital, right? We'll do a sale leaseback where you sell us the property, we lease it back to you. So we're providing, you can use that capital today to invest into your process. Today, Gaming REITs are about 3% of the index. They've performed very well since their inception. And so you always feel like, oh, we must have reached the end. We've hit all the property types there could be. But this is the creativity of capitalism. People are out there searching for solutions and finding creative solutions to problems, sometimes that people didn't even know they had.
What about airports? What about airports? I know all our pilots are thinking, should we be mad at REITs with airports, or should we blame someone else?
We haven't had airports yet. So globally, we have some privately held airports. Most of the airports in the U.S., especially the ones for commercial pilots are flying in and out of, are owned by states and localities. Often through an authority of some sort, like the Port Authority in New York. So we haven't had an airport REIT. I guess the opportunity there might be to own like small, some of the small airports that like weekend flyers fly in and out of. But I haven't seen that yet. That's it, Kevin. That's your opportunity.
Yeah. Is it a money losing business, Rob?
Well, let me take it, Rob. I mean, Kevin, if you want to make $1 million in aviation of any sort, you can, but you just have to start with $2 million.
Exactly. Yeah.
Good one.
I just hope someone buys the Denver airport and redoes it. That's all. Oh, this one's not in the script, so I'm going off script. We can cut it. Any thoughts that you have? It might be outside your bailiwick there, though, Dr. REIT. But any thoughts on a lot of talk of BlackRock buying up a bunch of residential property and real estate, and they're going to own all of the houses out there. Any thoughts on that?
Yeah, so we have single family rental REITs as part of our membership. It's part of the REIT, part of the REIT space. We actually think, and I believe this is a very positive thing for consumers, because they're creating opportunities for folks who, for whatever reason, aren't at the stage of life, aren't at the stage of savings, who can't buy a house today. They're creating opportunities to rent houses in nice neighborhoods with quality schools and good amenities, and frankly, without a lot of the headaches that go with home ownership. So I think it's a really positive development. They are actually out there building houses. So these single family rental REITs, they're actually creating supply. They're encouraging new supply. So they're helping solve the problem. And we think they're delivering value to their tenants, which is always the goal.
John, we appreciate it, man. It's been
it was
very, very interesting. So thank you.
I appreciate the opportunity to come on. As I said at the beginning, I'm in awe that you guys, sit down and say, I'm going to deliver these 250 people across the country. And they're going to complain if the Wi-Fi doesn't work. It's amazing.
We don't like that either.
Yeah.
Exactly.
Well, John, thank you. It really was a pleasure to have you on, and just a wonderful job. Hearing you speak about this asset class, which it got a little more exciting for me today.
Excellent.
So thank you.
Fantastic. I really appreciate it, guys. I had a blast. It was a lot of fun.
Dr. REIT, just again, to echo what the professor said, simply a pleasure to have you on. Lots of information passed on to our clients, which is super helpful. So thank you. I'll give you I think you maybe already did it, but the final words, and that's a lie because I'm going to wrap up after that. But what's your final thoughts?
I think the final word for your listeners is to really think about the role of commercial real estate in their portfolio, how it's an important part of every portfolio, and REITs are a great way to deliver that in a low-cost, liquid, and accessible manner.
Thank you so much. We really appreciate it. A couple of quotes for you to ponder on your drive or whatever you're doing, especially, this one's concerning real estate. So if you're out there maybe working on your property, find out where the people are going and buy the land before they get there. It's William Penn Adair. And then this one's my favorite, by Bill Shakespeare, known as William Shakespeare. I would give 1,000 furlongs of sea for an acre of barren ground. That's it. We've reached the final destination. Let us be the first to welcome you to the final destination of Flight 74, REITs with John, Dr. REIT Worth. And thank you for joining us here on the Pilot Money Guys podcast. If you have any questions you'd like us to answer on the show, shoot me or Charlie or Kevin an email, charlie@leadingedgeplanning.com or robert@leadingedgeplanning.com. Kevin, you can probably figure out what his is.
Yeah.
To sign up for our
If
newsletter.
you can't, don't call.
Don't call. Go to leadingedgeplanning.com. If you liked what you heard, hit that subscribe button. And remember, as Emerson said, the world makes way for those who know where they are going. And as we say, so plan accordingly. From all of us here at Leading Edge, take care, man.
Thank you for listening to the Pilot Money Guys podcast. It has been our pleasure to share some information with you today. Give us a call to discuss absolutely any investment question you may have. Click on the subscribe button below to be notified when new episodes become available. Visit leadingedgeplanning.com to learn more. Take care.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.